Hey guys, welcome back. Patrick here. Well, in this video, I'm going to show you how to completely dominate warrants in 2021. Warrants are super hot. You guys can see on the screen right now. This is just from last week, right? I made this video about BFT. In one day, 22% returns. Well, this has been going on all years with warrants. So if you're not investing in warrants right now, you're probably making a mistake. You want some exposure to it, but how do you do it? Well, first, you want to start with my other video, which I answered all of the newbie questions. If you haven't watched it, I'm going to put a link in the description. And after that, you want to watch this one. I'm going to share some of the answers to the questions that people have been asking me a lot. And then I'm going to show you some of the strategies I'm using to find companies like these that have massive gains, 22% in one day. What more can you ask? So stay tuned. Please like and subscribe. It really helps out. Alright guys, no wasting time in this video. This one is all about making you money. So today we're going to be talking about warrants, which are by far the best opportunity in the stock market right now. It is like shooting fish in a barrel, and you can make a lot of money very quickly. This is especially important for you guys that have smaller accounts. Let's say you have $5,000 or $10,000. The issue that everyone has is, let's say that you invest in one of the traditional stocks that makes 10, 15% per year. Well, at the end of the year, you'll have made a profit of what, $500, $600? That's just not going to help you with your path to financial independence. Warrants, as I showed you in the intro, you can make 20% in one day very often, especially if you're picking the right ones, as I'm going to show you some of my strategies today. So this is the spreadsheet I use to track a lot of my SPACs. I want to point you guys to GIK. We'll start with this one. This is a stock that they announced recently that they were going to merge with Lightning eMotors, an EV company, but the share price hasn't really run up yet. It's still at 1104. So this is the one big benefit that you're going to find with warrants, and that's why they are so powerful, is the leverage that you can get. So the share is at 1104, meaning you can take $1,104, you can go buy 100 shares. Or what you can do is you can buy warrants. Right now they're at $2.13, meaning if you look at this column here, leverage ratio, that means that for every share that you buy, you can buy 5.18 warrants of this company. Well, what do you guys think is going to happen when the share price goes up? Of course, you have to weigh in the pros and cons, and sometimes shares are better than warrants. We'll talk about that later. But you guys can understand that if you buy 5 warrants for 1 share, as the price goes up, you're going to get a lot more profits with your warrants than you would with shares. This is the main thing you have to understand, is the leverage ratio. Now, if you compare this column, right, you can see that not every company has the same ratio. Opendoor, which ran up, I don't know if you guys can see it, hold on. Opendoor, IPOB, has run up a lot. The share price at 25.70, right? Well, right now, the ratio is at 2.33, meaning you can only get 2.33 warrants for every share that you can buy. At that point, right, with the risks that the share price can go down, it might not be the best getting those warrants. So that's the reason, like, using this column helps me compare them also. As opposed to a company like GIK, we talked about 518. And right now, my biggest position, a company that I've reviewed before and I have extreme confidence in, Finance of America, RPLA, where the ratio is at 10.52 because it's completely mispriced. The warrants right now are at 97 cents. So for every share that you can get of Finance of America, 1025, I can buy 10.52 warrants. So over time, as the share price goes up, right, we can have these up to 5 years. Pretty confident they'll go up over time, right? Well, at 10-to-1 ratio, this is extreme leverage, and that's why if the stock just goes up a couple dollars, I'm going to make hundreds and hundreds of % profits on this position. So you have to understand leverage. This is one of the biggest strengths of warrants. All right, guys, let's do a quick comparison between warrants and call options, and you'll understand why I'm not doing a lot of options on SPACs anymore. So yeah, it's true that with call options, you are getting pretty good leverage, and in theory, if you're right, you will make even more money than with the warrants. But here's the problem with it, is that when you're investing in options, you need to be right about 3 different components. When you're investing in warrants, you only need to be right about one thing. which is the direction of the price action over the next several years. And that's what, to me, makes it a lot better. So with the options, you need to be right about the direction of the share price. And if you're buying a call, it needs to go up. If you're buying a put, it needs to go down. But you also need to be right about the time frame because of the expiration date. Let's say that I buy an option for May 21st, 2021. I have that set time frame where it needs to be reaching that price, or my option is going to expire worthless. And same thing with the strength of the movement, because you have to select a strike price, and if in that time frame it doesn't reach that strike price, your option is going to be worth zero. So that's why for everyday investors, I strongly encourage you to go look at warrants rather than options. It's just a safer, better play, mostly because if the share price is under $18, you have 5 years for the share price to go up. It is fairly easy, right, if you're investing in strong companies. All right, guys, before I get to the strategies, I do have to mention one more thing, because I get this question several times per week right now. Why is there such a big gap between the exercisable price of the warrants and the current share price? So we have a great example with ChargePoint SBE. Currently, the share price is at $34.95, but the warrant price is only at $11.85. So if you add $11.50, which is the price you'll have to pay to exercise them, that gives you a break-even point of $23.35. Why is there such a big difference between the break-even and the current share price? A lot of people are asking me, can I just buy warrants, exercise them, then sell them for $34.95, and I get that huge arbitrage opportunity? No, and the reason why is these will not be exercisable until 30 days after the merger. And what happens is that the market is pricing in that there's going to be a big drop in the share price. I mean, we've seen this time and time again with the SPACs. After the merger, when the warrants become exercisable, there's just a huge crash. So right now, people believe that the real price for ChargePoint is closer to $23.35 than it is for $34.95. So instead of buying shares at $34.95, if you wanted to open a position today, like you absolutely wanted to, it would still be better to open a warrant, buy warrants rather, and exercise them, because then your cost basis in the shares would be $23.35 when they become exercisable. But do keep in mind that the market anticipates that the share price will drop. One last thing I need to tell you guys, and this is more advanced, so we'll not go into a lot of details, is the delta variable of this change. So the further away you are from the $10 IPO price, the smaller the delta. That's what I've noticed. It's hard to pinpoint exactly the movement, but what that means is that the further you go out from $10, the smaller the increase in the warrant price is going to be compared to the share price. So let me dumb it down a little bit. Let's say that the share price goes from $10 to $15. There's going to be a huge increase in the warrant value, as opposed to if the share price goes from $30 to $35, the increase is going to be proportionally a lot smaller, because once again, people anticipate that eventually it's going to go back down. So keep that in mind. That's one of the reasons why when I list these strategies, I'm going to pay a lot of attention to the ones that are closer to $10, because proportionally, I'm going to see a much bigger increase because of the delta of this change. All right, guys, it's time for the big reveal. These are the strategies that are going to absolutely help you dominate the stock market in 2021 with warrants. All you have to do is follow the recipe. I can almost guarantee you it's going to work. I can't believe I'm giving you this for free. Merry Christmas. You've earned it. You've been a good person. Well, I've been using these strategies for the past several months. They've been working amazingly well. And as long as SPACs are popular in 2021, these are going to work. So just follow the recipe. So there are two main things that make the share price go up for stocks. The first one is hype, and then you have fundamentals. Hype is really good. I pay a lot of attention to it because that's how you get those big pops, like very quickly. BFT up 22%, and often, if you guys remember, I showed on the in one of the videos how I had highly on at $10 and then went up to 22 or something like that very quickly within a week or two. Well, that's how you get a lot of quick returns, is through the hype. But the downside is that often it's very short-lived. Within a couple of days or a few weeks, often it's just going to go back to like more of its normal price. So that's the downside with hype. You can pay attention to it, but always rely on the fundamentals. Like, that's the greatest backup. If it's a strong company that you believe it, within 5 years, as long as the revenues are growing and the company has a lot going for itself, eventually the share price will reflect the strength of the company. So even though it's not going up right now, well, within a couple of weeks, couple of months, yeah, a couple of years, it will go up and you will get your returns, right? Especially if you're very highly leveraged. If you make 100% in 3 years, well, still 33% per year. That beats the S&P 500 very, very easily. To really optimize your warrants play, you're going to want to look at 4 different things. The first one is fundamentals versus hype. We just talked about this. Your company needs to have at least one of the two, but preferably both. If you can find a company that has both, this is when you're not going to even believe the returns that you're going to get. Think about Laser recently, right, which went up past $40 when a few weeks ago the share price was in the low 10s. What was it, under $11, I believe, right? You're going to talk about hundreds, if not thousands of percents in gains with your warrants. I mean, it is hard to really believe, but it is happening right now. So do keep in mind, hype plus fundamentals equals money. Then the second thing that I'm looking at is I like shares that are between $10 and $15. All of these factors work together. If the shares are between 10 and 15, it means that you have more downside protection because all of the big investors in the pipe bought in at $10, right? So even if the share price goes to $9 after the merger, let's say, well, you're always going to have that limited downside versus if the share price at 35, well, then you have $25 that's quote unquote at risk. So also it's going to help you with getting a better delta, right? Any increase in the share price is going to have a bigger impact on the warrant price. And last but not least, it's going to help you with the leverage ratio. Another important thing to understand is that if the share price is under $18, you're not going to have your warrants be called after the merger. So the company, if the share price is above $18 for 20 days out of 30, will call the warrants due. And if they do a cash conversion, you're going to have to pay $11.50 per warrant or sell them if you don't have enough money. But if you bought them when they were at, let's say, $2 and the share price was at $11, well, then you're not going to really have to worry about that because if the share price does go to $18 plus, you will already be in the profits. So then even if you have to sell some, no big deal. You're just locking in some gains. So third thing, I like to look at companies that are where the warrants are under $3 or under $4. Like that's the maximum that I look at usually. The reason why is after that, I feel like the ship has sailed, and that's when like often the hype will have died down and you're going to be like kind of chasing a little bit, right? So you want to be one of the first, not one of the last, and that's going to really help you like protect your downside. That's always really important. And as usual, the cheaper you can get them, the better leverage ratio, which is the last thing that I look at and possibly one of the most important one. The higher leverage you have, the more the strategy is going to get you better returns if you're right and the share price goes up over time. Right? If you're looking at a company that has 2.32 ratio of leverage, even if the share price goes up, you're not going to be making a lot of money. But when you're talking about 1051 in leverage, any increase in the warrants, let's say 10 cents, right? Then you have 10,000 warrants, which you paid $10,000 for, you're going to be making $1,000. So that leverage ratio is extremely important, and it kind of helps you compare the different companies. I would rather go with a company like GIK, which right now I think is one of the best opportunities, which has a 515 ratio, as both hype and because they're merging with a electric vehicle company, which you guys know is very hypey, and as good fundamentals over a company that's already ran up a lot. Let's look at one, make sure you guys can see it. Let's look at even LCA, which I talked about earlier. I like LCA, but at $22.99, you're very far from the $10. The ratio is 252, so you get almost no leverage on this position, right? So to me, and plus the warrants are at 912. So to me, like this is a much worse warrant to purchase right now than at GIK, which is very close to $10, so huge downside protection. It's very likely that we'll see the same type of movement that we saw with Canoe, right, that went up to $18 very recently, or one of the other electric vehicles. The warrants are really cheap, 215, which gives you a 515 leverage ratio. To me, that is excellent. That is probably one of the best right now. So that's it, guys. It's not very complicated. These are the two strategies. You either want to go with short-term plays where there's a lot of hype and people are going to have FOMO and bid it up for no reason, and then you'll be able to get those quick profits. In that case, if you're doing those kinds of plays, I do recommend putting a very tight stop loss. In the example of BFT earlier, right, even though it went up 22% in that day, the next days after that, it started to retrace. So because I had my stop loss, just got stopped out, cashed out on my profits, and then I'll be able to do it again later. But if you do go for the other strategy, which is more long-term, like my play on Finance of America, but you can do that with GIK, that's a good one. Butterfly is one of the companies that has some hype, but also fundamentals, right? Then you're going to be more looking at it in a long-term approach, right? Even if it doesn't move in the next couple of weeks, well, you're more looking for catalysts that are closer to the merger or a year from now, you know, when there's the analysts and everything. So guys, I hope you understand at least the basics of this strategy. This is how you want to play the warrants. I gave you 4 things to look at. Let me know what you think in the comments. I do think if you follow this recipe, you're going to have such an amazing 2021. You can give me donations on PayPal. I'll take any money that you want to send me. I'm kind of joking about this one, but not really. Anyway, so I hope you guys have a great Christmas. I'll see you guys in the next video.